And I want to bring it on that note, folks, former Dallas Fed advisor Danielle DiMartino Booth. Danielle, you weren't happy with this Fed before the coronavirus outbreak. They've taken an extraordinary amount of measures. They've been extraordinarily creative. And it looks like they're going to get even more creative somehow, making Main Street loans. And who knows, eventually, if Congress will give them a nod, even buying stocks. Are they doing too much right now to help prop the economy?
Well, you know what? I have absolutely no trouble. The Federal Reserve has always been a conduit to banks in this country, and it's clear that that there's a little bit of clog in the system right now when it comes to getting liquidity to small businesses. So I truly take my hat off to the Fed in terms of how it can help facilitate small business lending through this Main Street facility. So I hope that that gets up and running very quickly and that we see details of that very soon. But as far as I'm concerned, that they've already crossed the Rubicon by bailing out the corporate bond market. The next step, obviously, would be junk bonds and then equities.
So on that note, they talked about yields in this report. One thing I have been surprised about, the guys just talking about that March 23rd low in the market. For a moment there, we saw the 10-year get above 1% yield. It's dropped back a lot since then. And it hasn't made a move commensurate with what we've seen, at least the resolve in the stock market. What's the bond market telling us, and just how much more do you think the Fed's going to have to help weigh in here?
Well, the bond market tends to look a lot more forward than the stock market, or at least that's been the case for the last few years. And because we've seen a resurgence of the virus in some parts of Asia, including China, I think that there is concern, and reiterating what Federal Reserve officials were saying in their March 15th minutes, that the global situation is not necessarily contained, even if we start to see a flattening of the virus curve here in the United States. We have to recall that the very first case in China was on December the 1st. So this is still a very young virus that is being studied, and we don't necessarily know what it's going to look like for the economy, if this is going to be a V-shaped recovery, which is the best case scenario, or whether we're going to see something more like a U or even an L. And I think that is what the bond market is, the reticence in the bond market is trying to tell you right now.
Well, I can tell you, since the minutes have come out, the market has been edging higher, a little bit higher than it was certainly before. Well, is there a notion, because again, you weren't happy as, something, I consider you to be something of a purist. You weren't happy with the way the balance sheet was swelling even before all of this. But what I've been reading is that maybe Powell and the Fed thinks that they have ways to keep interest rates so low for such a long period of time, perhaps 5, 10 years, even longer, that it won't be the kind of problem that people imagine it would have been just a couple of years ago.
Well, that's wishful thinking on their part. I think that the whole reason that we had such a huge vacuum sound and so much downside in risky asset prices in the first place was because the Federal Reserve left interest rates too low for too long, allowing too much leverage to build up in the system. So if you want to take that to the next mile and have the Federal Reserve keep interest rates down at the floor for a decade, let's see what that bubble looks like, Charles. It's time, I think, for
Danielle,
the Federal Reserve to conduct their emergency measures, but step back, allow capitalism to work.
Right. Let's go back to Edward Lawrence. He's got some more nuggets out of that report.
Yeah, 2 more quick points. One, most of the participants agreed that they should start the quantitative easing. They thought that would be a good idea when they went to zero on the federal funds rate to try and boost this economy. Also, they were a little concerned about, again, I said the dropping yields, the Treasury yields, but also concerned about how the economy going forward. Concerned for the reduction the reduction of 50 basis points, then 100 basis points would then spook the market also. So they were concerned about their actions causing more harm than good, but they felt like the good they needed to do overweighed the harm that they would cause by the signal sending, doing these 2 emergency meetings and 150 point cut. Back to you.
Great stuff. Danielle, we got just a few 30 seconds, but I want your thought on that. The idea that maybe the Fed was overthinking all of this when indeed we were in an emergency situation.
Well, it's obvious that the Fed had to come in and do everything that they possibly could so that they didn't allow systemic risk to become unhinged. But I am happy to hear that there's a little bit of hesitation that they feel like they might be going too far. Maybe somebody there will draw the line and not allow the Fed to go the Bank of Japan route and start to buy equities, which has done a whole lot of nothing for Japan.
All right, maybe there's a designated driver amongst the group. Danielle, always appreciate your insight. See you real soon.